This week was one for the history books. The volatility on Wall Street was unprecedented. The sell-offs were intense. The moves higher were just as dramatic, and the speed at which they were happening was once unthinkable. The Dow traveled 20,000 points during the past 5 trading sessions. Today, it rose 500 points, then it fell 500 points before closing with a gain of more than 1%. The Dow Jones Industrial Average rose 330 points to finish at 24,190, no longer in correction territory. The Nasdaq added 97, the S&P 500 climbed 38. But for the week, the major indexes each saw declines of more than 5% in one of the craziest stretches since the financial crisis. The Dow's sudden drop a week ago today had global markets reeling by Monday.
It's all about market psychology, and it is changing as we speak.
By the final harrowing hour of trading, the Dow was setting records, but not the kind anyone wants to hear about.
Wow, that was going to drive this. So now we're talking mini crash.
On the Dow Jones.
It's changing by the second here.
The Dow Jones Industrial Average is currently down just under 1,600 points.
Everybody thought the market was going to keep going up. It was never going to go down. And so days like this catch people off guard.
In just 10 minutes, the Dow lost almost 1,000 points and finished with its biggest one-day point drop ever. The big gains in January gone, and it got worse from there. After a 567-point drop at the open Tuesday, which put the Dow briefly into correction territory, down 10% from its high for the first time in 2 years, the Dow finished up, oddly, also by 567 points. On Wednesday, the violent swings continued, up 400 at one point, the Dow finishing down 19. And Thursday, the boat rocked some more.
We're talking about quite a nasty stretch here.
We are below Tuesday's intraday low,
Finishing down more than 1,000 points for the second time in a week. The wild ride continuing today, down more than 1%, then finishing up 1.4%.
This is going to go down in the history books.
This week, the Dow, the Nasdaq, and the S&P all hit correction levels. The 5th correction for the S&P 500 since the bull market began in 2009. And even with the wild moves, it's actually the least severe of the 5. After 2 years of unusual calm, investors are now wondering how more than half of last year's big market gains got wiped out. Some are pointing at the Fed, with interest rate hikes and fears that bonds with improving returns will take money out of the stock market.
I think that the low rate, low volatility environment is probably over.
Clearly, rates are rising. The Fed is tightening policy, and that has to have impact on equity markets. But it's not the end of the world by any measure.
So while interest rates may have been cause for some concern in the market, others say little-known volatility funds are what triggered the spasms of selling. Mike Santoli explains what they are and why they are suddenly getting so much attention.
Wall Street's slide over the past 2 weeks has cast a harsh light on an obscure corner of the markets, funds that invest in or bet against volatility itself. Volatility is simply how much and how fast stock prices change. For decades, though, the volatility index, known as the VIX, has provided a gauge of traders' expectation of future volatility. In the past several years, investment firms have created exchange-traded products whose value is based on whether this volatility measure rises or falls on a given day. Some profit from a rise in the volatility index, and others when it falls. The most popular vehicle to bet on volatility staying low, issued by Swiss bank Credit Suisse under the symbol XIV, lost nearly all its value in Monday's market rout. The way XIV worked, its return was equal to the inverse of the daily percent change in the VIX. For example, if the VIX falls 10% in a day, the XIV would go up 10%. In 2017, as stocks rallied in a steady, calm way, the XIV delivered a phenomenal 187% return. But when the VIX surged by more than 100% on Monday from 18 to 38, the XIV was effectively wiped out. Not before, though. The managers of the XIV and many other investors using similar strategies were forced to buy futures contracts on the VIX to try to offset their losses. This activity has been blamed for the continued surge in the volatility index, and in turn, it's driven other big investors who use the VIX as a signal of stock market risk to slash their stock holdings. There's no way to know for sure how important this activity has been in the messy, unstable stock market sell-off this week, but one thing is undisputed. These relatively new instruments exacerbated some of the selling and introduced a source of market stress that many investors never saw coming. For Nightly Business Report, I'm Mike Santoli.
And just today, Fidelity told clients that they can no longer buy shares in leveraged exchange-traded funds that bet on the direction of the VIX fear gauge. The firm says the goal is to protect investors from outside risk.
This tumultuous week saw a record $24 billion get withdrawn from U.S. stock funds. According to Lipper, the turmoil turned investors away from equities and in favor of money market funds, which are perceived to be safer havens. Outflows from ETFs accounted for the bulk of those withdrawals. The data is through Wednesday, so it is possible that even more money was pulled out